Welcome to my webinar. My name is Eric Martineau, and this is my lovely wife, Diane, and we are the owners of PrivateEquityBanking.com. Today I want to answer the question, where do banks put their money? And I say this in reference to the fact that I use an insurance company as my bank and not a traditional bank. And so I get questions all the time like, well, is my money safe with an insurance company? Is it backed by the FDIC? Why isn't everybody doing this? How come the financial advisor at my bank didn't tell me about this? If you're saying it's so good with banks, how come I haven't heard about it? So those are some of the questions that I kind of want to answer today. But first, I need to go into the fundamentals of money. And I know everybody watching this understands Money 101, but I believe at times, because of misinformation or because we try to compare apples to oranges, we aren't always comparing the same thing. So I'd like to lay down some fundamentals about money before we go much further so that we can compare apples to apples and oranges to oranges. First, there are three buckets of money. The first one is the taxable bucket. We all understand this, our income, our dividends, that's taxable right here and now. Then there's the tax deferred bucket. These are our qualified plans, our IRAs, our 401ks, all those qualified plans where we can defer our taxes into the future. Both of these buckets are leaky buckets because they are taxable. Then there's the third bucket, which is the never taxed bucket. And this bucket consists of some municipal bonds, because although you can get away with not paying the federal taxes on some municipal bonds, you still have to pay state taxes. That's why the asterisk there. Death benefits from life insurance policies and loans from life insurance policies are also always never taxed. A gentleman by the name of Ed Slott, he's a CPA. He is an expert in tax. In fact, he's been called by some of the most reputable newspapers in America, America's CPA. He says we need to move our money from the forever taxed buckets over into the never taxed buckets. All right? So these are the apples, the taxed buckets, and these are the oranges, the non-taxed buckets. All right. I would ask then, which bucket do you like better? And then the more important question, where do you have most of your money? Is it in a taxable bucket or a non-taxable bucket? All right. Also, the functions of money. In my mind, there are three functions of money. One, the banking, two, investing, and three, spending. What I'm talking about today, oranges, is the banking aspect. All right? This is where I warehouse my money, and when I need to, I borrow money. What do I want from a good warehouse? Well, I want it to be safe. I want there to be no risk. If I can get away with it, I'd love to have no taxes, right? I want access to my money whenever I want it, and I want a guaranteed growth that's substantial. That's what I would want from a perfect banking environment. Now, the investing side of the house. When I want to take money out of my warehouse and invest it someplace, what I'm doing is obviously putting my money at risk in the hopes that it's going to grow and get me a better return on investment. I also lump in paying off debts into the investing category, probably because I didn't have a better category to put it in, but I look at it this way. When I get a bill paid off, that means I have more liquidity to put back into my warehouse from which to decide whether I want to move it into the investing side of the house or the third one, which is the spending. And we all know that anytime we spend something, there is an opportunity cost involved with that spend, whether it is to maintain my lifestyle or to improve my lifestyle. When I spend my money, it's gone. That opportunity cost is gone. So back to what I'm trying to do today, which is differentiate between the banking functions, the warehousing and borrowing, versus investing. You see, I do not see private equity banking as an investment. I see it as an alternative to your bank. That's what we're comparing it at. We are not comparing it against, let's say, you putting money out in the market or buying real estate or something else where you put your money to risk. And that, to me, is the differentiator. When you put your money to risk, that is an investment in my mind. When there is no risk and guaranteed growth, that is a perfect warehouse. So that's why I wanted to differentiate between investing and banking, because what we're comparing here today is your banking functions, whether you do it with a traditional bank or whether you put it into an insurance company. That's what I'm trying to compare. All right, because what this does is that line that I've drawn there, that gives us what I would call my investment threshold. In other words, if I can put my money into a warehouse and I know that it's bringing me a value of, say, 6%, and someone comes along and says, hey, let's go put it in a mutual fund, right? And that mutual fund's supposed to make me 7%. I'm going to think, well, I can keep it here no risk at 6. Why would I move it down here at 7? That's how I would think. But you might say, oh yeah, I get 1% more, even though it's risky, and I could go to 0, I'm going to move it there. Or you might say, you know what, if I don't believe the prospectus is going to get me over 14%, I'm not moving it out of a non-risky environment where I know it's going to always get me 6. I don't care what those numbers are for you or for me, quite frankly. What I care about is distinguishing between what is a safe environment, that's like a bank, and what is an investing environment where I'm putting my money at risk. So I do not want to compare investments to banking. And besides, you can pull your money out of this banking environment and move it into investing anytime you want. You know that. All right, one more foundational concept. Banking 101. Again, this is to answer the question, where do banks put their money? So because most banks are FDIC insured, they can lend against their Tier 1 capital. So we need to talk about that quickly. Banks lend in accordance with the amount of Tier 1 capital they have in reserves. And this is called fractional reserve banking. There are many good videos out there on YouTube about fractional reserve banking. What I want to do for simplicity's sake is say that about 10% of a bank's reserves have to be kept there, and then they can lend up to almost 9 times that or 10 times that amount. So in other words, if a bank has 10,000 in Tier 1 capital, they can lend out 100,000. By the way, that is what caused the Great Recession, right? They had lent out a whole lot more than they had. When people came back and said, hey, I need my cash to pay off the stocks that are going down, the banks couldn't pay everybody back because they didn't have that. They had lent out 100,000, but they only had 10,000 in reserves. So that is one of the issues here, why the banks have to have a very safe asset as their Tier 1 capital. What the FDIC allows banks to call Tier 1 capital is cash. That would be easy to understand. Gold bullion, that's easy to sell. Loans guaranteed by the U.S. government, they consider those sound. And then cash value, cash surrender value on whole life insurance policies. All of those are considered by the FDIC to be Tier 1 capital for our major banks. So again, the question, where do banks put their money? You might think real estate. Why? Because we've all driven to a downtown metropolitan area and seen that the largest buildings out there all belong to the banks, right? Well, let's go a bit deeper. Banks are, in our country, and we expect it, right? Because they are the strongest force in the entire economy. They control the money supply. They control the usury you pay for a car, for a mortgage, for student loans and credit cards, right? They determine how much we pay to use money in this society. They are very powerful, right? They are in the money business. And who runs these banks? Well, they got a legion of economists and attorneys, accountants and data analysts, all looking out for one goal, and that is how to maximize the bank's economic output. We all know this. This is simple to understand. But the question then remains that I keep asking, where do the strongest banks, both in the world and in the U.S. economy, put vast sums of their money? I'm talking these banks right here, and you can show this with their profit and loss statements, and that's why I've put them up there, because you can see this, and I'm going to show you 2 of them right now. One of the world's most powerful banks, one of the U.S.'s most powerful banks. We'll just go through their numbers. All right, so where do banks put their money? It's called bank-owned life insurance. You surprised? Yeah. You've probably never heard of the term BOLI, but it is an acronym that is used by the banks. It's called bank-owned life insurance. Banks have so much cash value life insurance. When you look at their bank statements, you might think that they are actually an insurance company themselves. Well, the FDIC, because they're insured by the FDIC, the government accounting office actually goes and audits these banks. And here's what the government found when they did their audit on America's banks. 58 of America's largest banks have over 40% of their Tier 1 capital tied up in bank-owned life insurance. And over 467 U.S. banks had over 25% of their Tier 1 capital in bank-owned life insurance. And you're thinking, okay, but who do they get the life insurance on? Well, the banks use bank-owned life insurance, and they buy these policies on the top, say, 35% of their executives and their directors. So the C-level, the vice president level, etc. They get these policies on those people. Why? Because they can say that if their CFO dies, then they're going to have to replace her. And if they can't replace her quickly, they're going to lose economic value because of it. So that's how the banks justify purchasing these large bank-owned life insurance policies on their executives. It's for and it's also for the executives' pension plans. So they'll write into these policies that these executives can borrow against that money as part of a retirement plan, even after they've retired from the bank. Anyhow, also it's used quite often to cover employee health care for the entire company, the cash value there. They get tax benefits. It's tax-free when they get the monies back. They can improve their income statements on a quarterly or annual basis. Think about that. Let's say that the CFO that they used to have, she retired, I don't know, 10 years ago, and she's 80 years old now, and she passes away. But they kept that policy on her even after she had retired, right? She passes away, and all of a sudden the bank gets $30 million or $50 million or $70 million in a death benefit that they had on this officer that passed away, right? They get all of that money, and it goes straight to their bottom line as non-taxable income on that quarter. That's what boosts their income statements. Tier 1 financial. We've already talked about that. This is what the banks use as their foundational platform for lending to others in their tier 1. And then I thought this was one of the most interesting things when I read what the banks use BOLI for, and it's to recoup executive salaries. We were just talking about that. Again, let's go back to that same chief marketing officer. Let's say she had, gone with the company until she was, 55, right? And or she'd been with the company on age 55, she gets promoted to chief marketing officer. So they go out and buy more BOLI on her, right? And they figure, well, she's going to retire between 65 and 70. So she's going to be with us for maybe 10 to 15 more years, right? And then she's not going to pass away until she's 80 to 85. They can calculate how much they're going to pay her over the next 15 years as an employee, right? And then they can say, okay, let's get a death benefit so when she does die at age 80, we get back 3, 4, or 5 times the amount we paid her in a salary. Now you understand why these banking salaries for executives are so monstrous. Why? Because the bank knows they're going to recuperate every penny, or can recuperate every penny when that executive passes away, even 10, 15 years after they've retired from the bank. That's how they recoup those salaries, is with tax-free death benefits. All right, so went to the FDIC website and I looked up the Bank of America. Notice this is under assets and liabilities. On line 10, right, you'll see that it does say bank premises and fixed assets. In other words, they're real estate, all these big, huge monster buildings that we see in the downtown metropolitan areas of our nation. And look how much they had here. Now, notice that these figures down here are calculated in the thousands. So even though it says 9 million down there, what it's really saying is 8.6 billion or 9.3 billion. Okay, so that's how much real estate that Bank of America had. It increased from 2017 to 2018, went from 8.6 to 9.3 billion dollars of real estate. If we slide a little bit further down this statement, we're going to see on line 41 that it says life insurance assets. Yes, again, this is a tier 1 asset. And how much did the Bank of America have? Well, you'll see that they had in 2017 21.6 billion, and that increased in 2018 to 22.3 billion dollars. Let that sink in. You see those big monster buildings? Bank of America has 2 times more paper assets in life insurance on their executives than they hold in real estate. Let that sink in. All right, I went and checked out, and again, Bank of America is one of the world's leading banks. So I went and checked out Wells Fargo, one of America's leading banks. And same thing, assets and liabilities on the FDIC website. Their buildings come to a total of 8.5 billion in 2017, and again, kept it about stable, 8.5 billion in 2018, right? Slide on down, line 41, again, life insurance assets, and we see that Wells Fargo went from 18.3 billion in 2017 to 18.5 billion in insurance in 2018. Again, let that sink in. Look at those big, huge monster buildings in the most expensive real estate in metropolitan areas, and yet Wells Fargo has twice as much insurance on their executives as they have in real estate holdings. Back to Tier 1 capital, cash surrender value. Let's define that, because between these two banks, both of them have about $20 billion in cash surrender value. What that means is if the bank got into a pinch and they actually needed cash, well, one, they could borrow against the policy and get cash, but if they wanted to surrender the policy, which is why it's called cash surrender, that is the value. They could go hand back the policy to the insurance company and say, done, give me my money on what it's worth today. But obviously, what it's worth today as a cash value, which is the cash surrender value, is not equal to the death benefit. And as I said a minute ago, that death benefit is going to be between 4 and 5 times bigger. So when we see that these banks have about $20 billion in life insurance, the death benefit that they'll get if they just wait for that chief marketing officer to retire and then pass away, they're going to get the $100 billion return tax-free. Now you know where banks put their money. Again, back to Tier 1 capital. What's missing from this list? What isn't on that list? Well, we note that the real estate isn't there, right? What else isn't there? Market volatility. You'll note that the FDIC does not allow a bank to put money into the stock market and call that their Tier 1 capital. They don't invest there. That's where they tell you to invest, but it isn't where they invest. Again, this is the old do as I say and not what I do kind of scenario, right? So back again to what the banks say they use bank-owned life insurance for: to fund executive pensions, to pay for health care, to get tax-free benefits, to improve their statements when they get the death benefits, right? It is the foundation of their it is the solid foundation upon which they are allowed to lend, which is their business, right? And to recoup executive salaries. Let me ask you this. If you owned your own private equity banking policy, could you not take that same economist, attorney, data analytics minds that have figured out this is the best thing for banks and use it for your own pension plan in older age? How about your own health care if you needed it, having cash available to you? What about to improve your income statement? What about making it the foundation of your retirement? Again, I'm not saying it's your entire thing. It's the foundation, right? How much of your portfolio is in a guaranteed no-risk environment versus a risky investment environment? You can come up with that ratio, not me, but I'm just asking how much of it is there, right? Tax-free benefits for life, both growth and taking money out and using it. And then last of all, and I think this is the most mind-boggling thing, to recoup your life's salary. Think about that. With a cash value insurance policy, you can dictate today what your net worth will be upon your death. You could literally build a policy, use it as your own personal bank for 45, 50 years of your life, and then when you pass away, return to your family 1, 2, 3x the amount that you earned your entire lifetime and give it to them in a tax-free environment. Tell me that isn't amazing. You can dictate what your net worth will be at death by using the same methods that the banks use. So let's now compare, in this case, oranges to oranges. In other words, a bank account with an insurance company acting as your bank account. And in this specific list, I'm going to be talking about the warehousing and the savings. All right. So with a bank, if you put in 100%, you put in $100, you would have $100 available to you. 100% liquidity. We all understand that. But keep in mind, this is the reason for the Great Depression in America, right? The banks had $10,000 in deposits and they had lent out $100,000. And when everybody had to come back and get their cash to pay off their stocks that were falling, banks didn't have the money there. So remember that banks lend out at a 10-to-1 ratio. Insurance companies do not. Now, if there is a downside, and everybody asks that, well, what's the catch? This is the catch, all right? So pay attention. If there is a catch to using insurance companies as your bank, this is it. Because in year one, when you put in $100, you're only going to have $60 to $70 available to you to borrow back out. Why? Because you're still buying insurance. Again, this is something that has been approved by the IRS, but the IRS says it still has to wiggle and quack like an insurance policy, not an investment, right? And that's what the IRS is trying to say, is as long as it still looks like a bank account, it's okay. But as soon as it starts to look like an investment, they don't let it. And so you do have to still buy life insurance with it. And so in year one, you're going to be at about, you put in 100, you'll have $60 to $70 available to you. By year three, when you put in 100, it should, with year 3 to 4, depending on your age and your health, when you put in $100, you should have $100 available to you that you could borrow back against. So it's at about a 1-to-1. Now, when it totally breaks even, will even take between 7 to 10 years. In other words, you've now paid off all what you're putting in on an annual or monthly basis is always larger for the overall scope of it, and that is between 7 and 10 years. So if there is a downside to using insurance as a bank account, it's that it's a long-term thing. This isn't just to stuff it in there for a couple months and borrow it back. This is a long-term play over your life. All right, next. Bank-owned money. Bank owns your money. I don't know if many Americans understand this, but when you put your money into Wells Fargo, you get your check from your employer, and you put your money into Wells Fargo or Bank of America or your credit union, I don't care who it is, when you put that money in, the courts have found year after year after year, case after case after case, that the banks own your money. They have complete control of where they put your money. That's why we bailed them out in 2008. Remember? Anyhow, you become their creditor, and you are way down on the list as far as where that creditor goes. Again, as an insurance company, right? First of all, they don't do fractional reserve lending. So if an insurance company takes in $100, they'll only lend out maybe 80 of that total, not 800 or 900 or more, right? They don't do that. The insurance companies have a contractual. They are contractually bound to you as a co-owner of the insurance company if you're talking about a mutual company, and I only use mutual companies. So you become a co-owner of that insurance company, and the executives in that company have a fiduciary and a contractual obligation to you. That's why when you want to borrow money, you get first priority over them lending it to, say, some municipality to put in fiber optics. They will never have more money lent out than they have in their coffers. So you could always come back and get your money at any time, and the insurance companies aren't going to have a problem with this, okay? There's not going to be a run on the insurance companies, I guess is what I'm trying to say, like there could be with the banks. Your money with a bank is not protected, creditor protected. In other words, you cause an accident tomorrow and you hurt somebody, their attorney can lock up your funds in your bank account, right? Well, if you're found guilty, you're going to have to pay a price, right? They can do that with your house and things like that. They cannot do that with your insurance policies. It is safe from creditor in most states. There are some states that aren't that way, but in most states it's that way. Transfer the money with taxes. So if you've got $100,000 in your bank account and you want to give it to your kid's going to have to pay taxes the moment you move that $100,000 over to them. With an insurance policy, you can change the ownership of that policy from you to your child, pass the entire thing over, no taxes paid. Cash increases are taxable. So when your money grows inside of a bank account, as you know, you get that 1099 saying you made 37 cents in interest last year at your bank, right? Because they pay such low interest rates. But it is taxable. With an insurance policy, all of the money that goes in and all the money that you borrow back out is tax-free. And an interest rate, we already know what the banks pay currently, and that's well less than 1%. Whereas insurance companies currently are guaranteed by contract by the IRS and Congress. So the Congress has written the laws, and insurance companies must give out a 4% return. Now that is lowering. Due to COVID, they had that big bill that passed and lots of people threw their stuff in there. Insurance companies have been given the right this year to move that down, and we've heard that it's going to go down to about 2.75 to 3 point something. But that's the guaranteed portion. Remember, you still get dividends on these, and the prospectuses I've seen so far, the illustrations I've seen so far, are still planning on giving between 4.5 and 6%. It's just there's going to be a larger proportion of that. It is a dividend, in other words, not guaranteed, and the guaranteed portion is going to drop from 4 to about 2.75. But that's still huge compared. Again, comparing oranges to oranges, your bank account versus an insurance, that's still probably a 300% increase over what the bank is currently giving you. All right, now we're going to compare the borrowing function between a bank and an insurance company. When you want to borrow money from a bank, you have to qualify to borrow that money. And the bank determines whether or not you qualify. Whereas with an insurance company, if you've got a cash value account and you've got money in it, you qualify. Second, a bank sets the interest rate, as we know, and it's dependent upon your credit. So if you've got a 580 FICO score, you're not going to get the same interest rate as somebody with a 780 FICO score. All right, with an insurance policy, it doesn't matter what your FICO score is, everybody contractually gets the exact same interest rate. Bank determines the repayment schedule. In other words, you borrow to buy a car or a home, you have to pay your bill every 1st or 15th or whatever date they've given you. Whereas with an insurance policy, because your death benefit acts as the collateral, they don't care if you ever repay it. So you never have to repay it. You should, but you don't have to. Bank owns your collateral. until you've paid off the entire loan. So again, you buy a house or a car, the bank really owns that until you've paid that off. Whereas again, as I just said, your death benefit becomes the collateral for these loans with an insurance policy, and they don't care if you ever pay it back, because at death, they're going to be able to recoup their monies, and so they're not worried about it. Your estate with a bank, if you owe money to a credit card company and you've got $20,000 in your bank, that credit card company has the right to come and get that money from your estate before you give it to your children. In a death benefit or your beneficiaries, regardless who your beneficiaries are. In this case, your beneficiaries will get your death benefit without any strings attached with an insurance policy. All right, extra payments do not buy leniency. This is where Diane and I lost everything that we had for retirement in 2008. We had been Marines, we had traveled, and every time the Marine Corps moved us, we bought another fourplex or a duplex or another property. And by the time we retired or got out of the military, we had about 16 rental properties. And in 2008, I lost my job with the recession, and we had put all of our properties on 15-year notes. So the notes were larger than usual. So the rent was this much, the note was this much. We had been paying in extra every year, trying to get all that done by the time we were 50, and we lost everything because I didn't have a job and we couldn't cover that. And if I had had one of these policies, that wouldn't have happened to us. So extra payments here always go toward principal. Your credit score with a bank is only 30 days away from being bad. And as I said, you don't pay on your policy with an insurance. You don't pay on your loan with an insurance company. Doesn't matter. They don't care. They're not going to tell anybody you didn't make a payment this month. Your credit doesn't go anywhere. In fact, the insurance company doesn't care how you use the money. You want to borrow $20,000 for a car? Borrow it for a car. You want to borrow it to go on vacation? Borrow it to go on vacation. Insurance company doesn't care, whereas a bank will. They're going to ask you what you're going to use that money for. There's credit checks and applications, all that kind of stuff. None of that happens with an insurance company either. So here's one of the most important things too, in my mind. When you pay down your loan with a bank, your account goes to zero. You've got nothing left, right? But because of the way you can use arbitrage, the simultaneous use of your money, you've got your cash value accumulation account that grows and grows and grows. You never touch it. You never borrow that money back from the insurance company. That's just money that grows, right? And then when you borrow money from the insurance company, it's from the insurance company, not your cash value account. And so as you pay down on that, that one shrinks. So this one finally gets to zero, but this one has never stopped growing. And so that allows you to have cash value accumulation grow and grow and grow, and use this as an arbitrage so that when you've paid back this piece, this one has still grown and never gotten smaller. Amazing. So these are the benefits of using private equity banking over a bank account. So in other words, using private equity banking with an insurance company versus a bank, putting my money in there. You get guaranteed returns with zero market risk. You get liquid cash. You don't have to wait till you're 59 to get that money. You can get it anytime you want. You can pay it off when you want. You can use it all of your life. You also have protection, both from creditors and dips in the economy, both macro and micro level effects. Tax-free. It doesn't grow tax-free in a bank. It does grow tax-free with an insurance company, and you can get that money into your hands tax-free also, both through the death benefit and through borrowing. Compound interest. I guess you could call getting a 0.05 or 0.01 interest rate from the bank compounded interest, but that's going to take forever to grow with the rule of 72. At least here, it continues to grow and grow and grow, compounded interest. And then, as we just spoke about, the arbitrage, which is for me the most powerful part about this. Your cash accumulation account continues to grow, whereas the part you borrow from the insurance company can be paid off, and that goes away. So those are the benefits. That's where banks put their money. Again, my name is Eric Martineau. Love to help you out. It doesn't cost you anything to get in touch with me and say, hey, let's see what a private equity banking account would look like for me. We'll talk through some numbers. I can show it to you. And again, everything comes with a guarantee. When you see what I put together for you, you'll know that is exactly what it'll be at age 45, 55, 65, 75, 85, etc. There will be no variation from it. It is guaranteed. So like I like to ask, how much of your financial security is dependent upon people, economics, and companies that you can't control? And how much of it, like the banks have in cash value policies, is the foundation of your financial security that doesn't depend on those things and is guaranteed, and guaranteed tax-free? Look forward to helping you. Have a great day.